One, we do these weekly for clients, but this is kind of an ask us anything. And Craig and I are a little worn out by this chop of the market. So I'm going to just kind of throw it over to you. Give me your assessment. We were just talking about this. What do you think we should do from here while we're waiting for the next move?
Yeah, I mean, this month's been crazy. This year's been crazy. I mean, we walked into the year and stocks rallied on back of, a fall in the terminal rate that was driven by the recession fears. And that was what kind of drove us higher in January. And then you wake up in early February to better than expected data on the employment side and then on the inflation side, which then flipped us the other way. And everyone said, oh crap, we're not going to be lower terminal rate. Let's raise the terminal rate. And so we kind of spent February raising the terminal rate. Data's getting better. And then you kind of walk into, the early part of March and Powell speaking to Congress, and he, after getting another strong employment payroll, which suggested that the January data was actually not a fluke. And so he says one or two hike, maybe we'll go 50. We're going to be raising the dots, and, rates scream higher and kind of trigger that break of something, right? And what that break was Silicon Valley Bank and Signature Bank and the banking crisis, I put that in quotes, to then have a 1 week banking crisis that led to, a historic Fed liquidity pump, and which then has eliminated, that high terminal rate, has kind of brought back in interest rate cuts, which had been completely priced out. And so the market has now rallied back to the highs basically for the year on a banking crisis that causes a hard landing in the economy, which causes the Fed to cut rates. So in my view, equities are pricing the front run of the front run of the front run. We're so far ahead. But look, when the Fed comes out and delivers the liquidity additions that it did, whether or not it's QE or not, and back and it's not QE, it doesn't matter. People look at the balance sheet, they see the expansion, they see how quickly the Fed reacted to, quote, systemic risk, and they say, the Fed put his back. And even though inflation is still elevated, and even though employment is still very strong, markets are seemingly saying, we're happy being strong, long and strong here. This recession that's coming, we don't care. The Fed's going to accommodate, and it's the old playbook from the last 15 years. And so I think you can tell in my voice I'm a little bit skeptical, but look, without a Fed that looks to push back against that narrative, the market is free to price that series of outcomes. And I think when you kind of combine that with some of the liquidity issues, kind of intraday liquidity issues or lack of liquidity in trading, and some frustration, and really, some pretty horrific hedge fund performance, to start the year, kind of in the macro community, some of the multi-manager community, and in the CTA community, without the volume in there, the markets are being driven by, zero data expiry trading and the gamma levels and expiries, and obviously, quarter end, there's this big expiry trade, which I'm sure we'll talk about. So, on an any given moment type basis, the markets kind of can do whatever they want to do, but I think we are still set up for, a challenging second quarter and second half as the economy slows and the Fed, needs to kind of battle the market, but also battle this banking crisis and try to figure out how to navigate that in an environment of inflation that, still is strong. I mean, it's just, we haven't seen the level of deflation that normally would come with a banking crisis like this. And so, the Fed didn't use this opportunity to, bring down inflation expectations enough. So we'll see. We have PCE on Friday. It's the end of the quarter, and maybe there'll be some fireworks, but
non-farm payrolls after that.
Yep.
So two takeaways in large part that I have for this, even Sunday when they came out with this, bank bailout measure or stream of programs to stem the bank deposit flows, it was really an implicit pivot, right? So market immediately just interpreted that as, okay, now we're going to have this loose monetary policy. Let's run. So it had been pretty strong out of the gate since Monday, March 13th. That's the first thing, this implicit Fed pivot. And then, of course, the Fed does go through and raise. So now it's off. The market is seemingly off sides, not in sync with what Powell is warning of more hikes and more QT. But that's the first kind of bifurcated sense, right? This loose monetary policy is good for NASDAQ, Bitcoin, gold. The other, however, is this whole banking crisis, even if resolved peacefully, no other shoes drop, so to speak, here or abroad, there's still pretty much consensus that lending will be absolutely constrained. So this will be an economic slowdown coming, but we don't see it yet, so we don't price it in yet. So I guess my question is, when do we get to that point where we can kind of foretell that the bank lending has definitely frozen or at least restricted the growth considerably, and we start to actually price in that activity? Because right now the market clearly refuses to do that.
Yeah. Mind if I share my screen here real quick?
Yeah. Oh,
Am I able to do it?
absolutely. Hit it.
That's not this. Let's see here. Can you see this chart here? Let's see. I know it doesn't. Sometimes it doesn't come up. Great, but this is the senior loan officer survey that comes out quarterly, and so we can already see and hear the tightening in lending standards and credit conditions that bank senior loan officers are already kind of targeting. This means 45% of banks are targeting tightening lending standards, and this is before the banking issues. So we had already really started to see tightening of credit, and like you can roll this chart back here. This is the financial crisis. Kind of we started moving. Put a bottom in April of 2007 and move this all the way up here, similarly in, during COVID, boom. And so banks have been tightening credit, for a while now. And I anticipate this will continue, in a large way here now over the second quarter as regional banks are dealing with deposit flight, as asset valuations in commercial real estate market continue to come down. So I think we're gonna see this continued tightening of credit. And look, when you say it doesn't really show up, when will people care? If you think about like big tech doesn't need cash, right? They don't borrow. And so I think it's not surprising that we've seen, broadly speaking, this is a chart of, Qs versus IWM as a proxy for, growth versus value. You could just see the explosion that we've seen here as credit conditions have tightened, right? It's worse for the real economy. It's worse for small caps than it is for large caps. So I think, I guess in a way, the equity market has got it right in that you want to own secular growth during a period of cyclical growth momentum deterioration, right? But I think we've more than priced that in, and now as we transition into the second quarter, the actions of banks tightening standards 3 and 6 months ago will now start to hit earnings kind of across the board, and so the question then becomes, as equities can get sold because earnings are worse and yields don't fall as fast as people want them to, you kind of lose on the P side and you lose on the E side. And so I think that's the setup that we're kind of getting into here for the second quarter. And it's not uncommon to see, kind of this type of NASDAQ outperformance, like right at as the economy is flipping over into, a real protracted slowdown, right? The market kind of moves ahead of the economy in that regard. So I think we're kind of there. And I think, these charts here this chart here kind of indicates that it is happening already. And so I suspect this small cap underperformance and cyclicals underperformance is probably going to continue.
Let's talk about earnings for a little bit. Let me just grabbed a quick chart here. And then let me share. Get some earnings. You can, sorry about that. I wanted to hit share screen. I'll get it. Hold on. Let me get this over here. All right. Sorry about that. There we go. And then I'll put this here. All right. So on the earnings front, see this screen, hopefully. All right. So that's, GDP estimates right now. We've got for Q1, they continue to tick a little bit higher. We've got now consensus about 2.5%. That's up from 0 at the beginning of the year. And this is driven in large part by, upgrades, stronger than expected consumption, which is running about 4% annualized rate. And then we also have earnings right now. Revenue and earnings tend to trend with nominal growth, which is also above trend at negative 7.4%, but it's rolling over. When are you seeing this decline in the earnings expectations and earnings recession risk, if you will, that will start pulling forward some of the equity de-risking? Because right now it's not seeing this.
Yeah, I mean, look, I think what you have is this is your kind of first, the first move here. I mean, this chart dates back to what's the this is
literally
weekly
September 30th to March 23rd. So
yeah, look, I think we're in the in the teeth of it. I think you're going to have companies that come out in this first quarter with kind of inline-ish and then weak outlooks. I mean, uncertain outlooks with respect to kind of concern about the future of credit tightening, about a lot of talk about these banking issues. What does that mean? And I think from on the chart here, that you have. I suspect, the energy numbers, given where oil and gas have priced, it's very hard to see how energy companies are going to be growing earnings this year, unless crude has a material move higher, soon. I mean, gas is, down 50% in the first quarter, and energy is, is down year on year. So I would imagine this energy chart is moving to the right there as far as, earnings expectations are concerned. And then similarly, as cyclical growth momentum deteriorates, industrials and material earnings momentum, should roll over as well. So it's not, and then obviously, given what banks are doing, hard to see how banks are going to, provide a ballast for earnings. So where is the earnings growth, really going to come from here? And I think what the market is missing is there is a implicit kind of immaculate earnings growth recovery story kind of being priced into the second half of 2023 and 2024 earnings. And it's just not clear where that's coming from, where that excitement is coming from. When you have elevated cost of capital, when you have still sticky inflation on the labor side, where is the a fiscal situation that is not going to be providing incremental stimulus, the geopolitical concerns, still elevated kind of food price. I mean, where is this euphoria about next year's earnings coming from? I'm just not really seeing it. The question is, are we going to get these companies to kind of give up the ghost on this call, or do they hold off to the next? It's unclear. I mean, the ones that are most exposed will start to talk down numbers now. The ones that that have some hope we'll hold on, but I think it's going to be kind of a rolling deterioration of earnings growth expectations and momentum as we cycle through this earnings period. And the early reporters of the banks, kind of second week of April, they'll set the stage. And yes, banks are very oversold, and maybe we'll get a rotation trade constructed banks for a week or 10 days kind of into those numbers, but that's short term. I mean, it's hard to see where banks are going to be able to kind of grow earnings anytime soon. So
there's a great post that I'm showing right here. Hopefully you can see it. Brian Gilmartin did, where he's talking about the Qs. This is this weekend, up, 17% year to date. Technology way offsides at, EPS growth of negative 0.5%. So something's got to give. Either technology sector's earnings will support the 23 relative strength, or the S&P may have a bigger problem than the banks. So right now we have massive concentration risk in the XLK, the S&P tech segment. It's what is this? I actually had this chart up here. It is concentrated weighting in S&P, almost 27% weighting just in these, top tech plays. So it's a very strange market to have this outperformance, and yet the expected 23 EPS growth is a negative 0.5%. How do you square that circle?
Look, I think, when you're concerned about growth, you push your capital into flight to safety trades. And so gold's been working, bonds have been working. Let's put Bitcoin to the side for a second, although Bitcoin's been working as well. Big tech is seen as flight to safety. These are cash-rich companies that are behemoths in their respective spaces for the most part: Apple, Google, Microsoft, NVIDIA, right? I mean, and so they'll be around forever, and they generally do smart things. And so folks feel comfortable putting capital into those types of secular growers when they're concerned about cyclical growth momentum deterioration. So the outperformance has not been, clearly it's been aggressive and sizable and actually historic to a large degree. But this is the type of market that we're in, right? Market goes to extremes so often in both directions, and we push and push and push and push and push, and then it stops, and then it goes the other way. It happens time and time again. What's been most surprising to me is that we haven't. I've been kind of calling for, this alpha trade to unwind, and then to lead to more of a beta faceplant and markets down. And the reason that I think that is because, or I thought that is because I continue to see liquidity being withdrawn. And so, the question now is, after 2 weeks of massive Fed liquidity additions, now, it wasn't QE, whatever, it was a liquidity addition and monetary expansion that kind of pulled water in my view. But in the environment where, let's say that, when we get the numbers tomorrow for bank balance sheets as of the end of the day today, what happens if the Fed balance sheet comes down because the banking crisis has been solved? Are folks then going to say, "Oh crap, now liquidity is being withdrawn again, like I should sell my stocks"? Maybe. It's not, I'm not entirely sure, but I think that the reason that risk has traded better for the last 2 weeks is because liquidity has been added. So if liquidity starts to be withdrawn because the banking crisis is not getting worse from here at this point, I don't see how that's going to be constructive for the broad tape. It's possible that for a moment the banks will outperform because there'll be this perception that they're safe relative to where them not being safe, because liquidity is being withdrawn and they don't need as much. But then we go back to, okay, where's inflation? Where's the Fed likely to be? How much of the cuts are we priced in for already for 2023? And people have to remember that the market's already looking for 3 to 4 cuts from the terminal rate high of May. So the Fed actually has to deliver that or more in order for them to be dovish. At this point, kind of recognition that they're not going to be doing that, whether it's through data or statements or what have you, is a hawkish outcome. And so back to the framework of economy, markets need liquidity in order to go up. Well, then we're going to be pushing ourselves further away from kind of receiving that. So,
and before we talk about the real liquidity pull or push with the debt ceiling, I just want to kind of show that I have a chart up, which is a little bit of that beta face plant idea, just to plant the seed. As I had, was already kind of pointing out that we've got a very large concentration of the, largest cap weighting in SPY, obviously over half in NASDAQ. Now, this is what that represents right here is this is the January kind of January effect where growth started to outperform value. We had a petering out in February, and then of course post FOMC, and then especially the bank bailout right about the 10th, we had this trigger just go straight up. So all that concentration risk in mega cap tech mostly. So now it's starting to come back down again. So the banks and regionals and large as well, but also the reflation trades, right? The XLE, the XLI, all of that, plus the defensives, they've been stabilizing and bouncing. So we're now seeing that kind of reversal. And you had made the point that it likely wouldn't get going until around April 1st, this end of quarter window dressing, not to mention, funds wanting to keep some names on the books, and then it'll rotate first part of April. Is that still your baseline bet?
I think, I'm just looking here.
This, by the way, is a growth to value rotation on a daily for those who are.
Yeah, let me just share this, if you don't mind.
Yeah.
This is that chart you just had up. I just created a heat map where you can see this is for the last 10 years, right, of performance of the IWF versus the IWD. So 3% January, 2.5% in February, and then another 7% in March, right? So this is obviously there's been times in the past where but 7% move in March and call it 12% in a quarter. It hasn't been that many quarters back for the last 10 years where we've seen a similar outperformance. Obviously one that comes to mind is this 2020 period here. This is during COVID, right? This is massive outperformance to start the year, and then as the market fell, it still outperformed. So look, I think it's possible that if the banking crisis accelerates from here, I think tech will outperform, but with both tech and with both growth and value falling. I think if the banking crisis kind of pauses here over quarter end, then this outperformance that we've seen, to start the quarter maybe has a little check back here, right? And for a 1 or 2 or 3 week period to digest some of that those overbought conditions. But I don't think that's like a sustainable move. Like, I don't really think there's many reasons to own financials, at this point in the cycle. And so beyond a short-term 1 to 3 week counter trend trade, I think folks are going to be looking to, to sell that. And as a proxy for value, I suspect that will be the underperformer too. So I'm really thinking, possible short-term trade here, which I'm not participating in, that maybe banks and value can outperform on a short-term basis as we kind of get into the new quarter and folks start to, shift portfolio exposures that they're in overweight and underweight. But I don't sense that's a sustainable move, for 2023 at this point.
I want to show you my chart that I have shown before just to kind of update. This is that gap SPX earnings on a monthly. So it's very much a trending indicator. This is when you were just talking about, we went straight up with all that lovely QE. and lots of liquidity. And since then, we have obviously petered out in 2022, but earnings really haven't. So even though we pulled back in price, we have not in earnings. They're still probably about 20% too high. So at least 20% too high.
Yeah.
But the point is, we've definitely broken below, kind of like, I'm cherry picking this indicator, but I love this because it's very, very instructive. It has only flatlined twice, the pink arrows. Otherwise, it has been dead on, go long, go short, and a big picture. Anyway, so this is definitely, you know, come underneath the green, the indicator, and expected to have another quarter or two of weakness. But again, I think we need to come down about 20% for this to really be even back to where we had the COVID breakout. So it's a 2023 timeframe, but it's definitely not happening it's not happening fast. So what do you think this quarter is going to look like? Q2 has been my baseline bet for disappointment for earnings. Kind of pace yourself during, you know, last year, Q4 wasn't going to be an issue, but once we get into Q2, it would be. What's your thinking of when are we going to have the big weakness in earnings?
Yeah, look, I mean, I'm just looking at just a couple of names here. Like, I mean, Apple earnings expectations they were down 10% for the first quarter, or, you know, for their first quarter, which is anyway, for this quarter, they're supposed to be down, they'll be down 6. Google, you know, is going from down 10. Market expects Google to go from down 10 to +7. Not exactly sure what that's about. Let's see, Microsoft here is, you know, is going from +4 to down 6. And I think like something like an Exxon, I think is something to, you know, keep in mind. I mean, so Exxon earnings grew 66% in the fourth quarter, expected to go 21% year on year this quarter. And then next quarter, the second quarter, down 41% year over year. Right. So that's something for energy where folks have been very constructive on the energy sector.
Hiding out
hiding it. The inflection point is now, right? This is the last quarter of year on year growth for the energy sector. The outlooks are going to be abysmal in energy, given where oil, they're just going to say, this is where oil is, this is where gas is, this is where our, you know, our sensitivities are. And, you know, it's going to be hard for folks to want to buy the sector where you're staring into down 40%. You know, Chevron's looking at a down 40% earnings for, you know, 2Q. You know, someone like Caterpillar. So CAT as a proxy maybe for industrials, 43% earnings growth in the fourth quarter, 30% this quarter, going to 22% next quarter, and then 0 in the third quarter, right? So you can see, you know, how maybe that sector is just, you know, kind of maybe that trails, you know, energy by a quarter. I'm looking at like Dow Chemical. That's probably not a good one. What's a good like Lyondell? Lyondell, which is a big chemicals, you know, producer, you know, down 65% in the fourth quarter, down 55% this quarter, down 52% next quarter. These are just not, you know, these are not numbers that I think folks are going to really be wanting to own. So I think right now is when you have tech not showing incremental momentum from the earnings side, and you're finally catching down on the earnings growth expectations for some of these more cyclical sectors. And so I think, you know, outside of the historical seasonality associated with April, which is typically a good month, kind of maybe exiting April into the sell in May and go away type situation. You know, I think that's how we start to carve out much lower ranges for markets. I mean, if we look back to the chart that you just showed, you know, thinking about a 15 to 20% earnings growth hit from where we are right now, I mean, you're talking about a market that should, you know, that is looking at, you know, 200 or, you know, sub 200 in earnings per share for 2023. I mean, what kind of multiple do you want to put on that when the 10-year is between 3.5% and 4%? I mean, I don't know. Historically, you'd be in the mid-teens camp with that. So if you're talking about, you know, 14, 15, 16 times 200 in earnings, I don't know. I mean, that's how you get to 3,000, right? That's how you carve out a much lower outcome for, for equities. Now, maybe folks will say, well, the 10 years going back to 1% or 2%. I don't believe it that it will. And only get there if we have a very sizable deflationary bust associated with the banking sector, in which case we should also be a lot lower in equities first. What's that?
Does it have to be a deflationary bust or just an impulse? In other words, I like to use the word deflationary impulse because it means, we've seen an inflation peak. Now we're kind of going over the mountain. It's going to be waves. So we're going to go, down. Maybe my baseline, right, is that we're going to break that 3.33 in the 10-year. Would not at all surprise me to have that pull back down to 2.6% and then get firmly defended and shoot higher. So to me, it's just a dance, but it seems dramatic. 2.6%. Oh my God, we were just talking about 4.1 a month ago. So, things have changed. What has changed?
Everything just seems like it's happening faster, right? The speed.
And yet the market's going nowhere fast.
Yeah. Well, we are, it's like the narrative Olympics, right? I mean, the narrative shifts daily, weekly, it's economy's good, economy's bad, Fed is tight, Fed is loose, liquidity is being added, it's being taken away, every other day, it's kind of a new story. And when you amplify that with zero data expiry trading, if you're stuck in the screens every single moment of every single day, you could drive yourself crazy. If you step back and you try to, say, this is where I suspect we're going to be in a month or two, depending on your time frame, I think you don't get tied up in this, but you need to be willing to wear P&L volatility in the meantime. And as a retail investor, it's easier. As an institutional trader, at some of these multi-manager platforms, there is no tolerance for drawdowns. And so the hypersensitivity of markets is because folks are not really allowed to take losses. And so they get stopped out very quickly. Maybe it exacerbates moves. And so that's the manic trading in, daily, intraday, over the course of the week. But
it's also a stark contradiction. I mean, if the earnings recession is right now just forecasting, I'm talking consensus, a -7%, right? But my chart is, obviously looking like it wants to roll over a little bit more than that. And a peak to trough usual decline in an earnings recession for 40 years has been a drawdown of -23%. Now, it makes sense if the market is pricing in rate cuts because they're pulling forward recession risk. It would make sense if earnings also started to reflect that and price it in, but it's not. So they can't have their cake and eat it too.
This gets back to the front running of the front run. And I think it still has to do with that there's too much liquidity, in the system. I mean, just
Micron's a perfect case, right? I mean, they had their worst quarterly loss on record. Negatively guided down, wrote down hundreds of millions of inventory, but the bulls think that it's the worst is priced in.
Yeah. And
their AI will save them. So it's definitely an interesting psychology. They're clearly not pricing in recession.
Yeah. And with a Fed that did a year's worth of QT and kind of eliminated 2/3 of that in 2 weeks with the balance sheet expansion, folks are saying, look, there's always going to be a plethora of liquidity around, and every dip is bought, because if it gets too unwieldy, the Fed will just provide more liquidity. So whenever there's a sell-off in any name or in any sector, it's a viable moment. And for a while there, up until 2 weeks ago, I guess, the Fed was pushing back against that and saying, at times, we're raising the terminal rate. We don't really care what equities. And look, equities did not have a great year for the first, 9.5 months of 2023. So it's not as if the Fed hasn't seen equities fall. But the reaction function after 2 weeks of how much liquidity has been added here on an emergency basis, the market has just completely kind of stepped ahead of that and said, okay, tightening agenda over, can't raise rates anymore, liquidity is coming, more is coming. The worse it gets, the more liquidity that we're going to have, And so let's just preempt this earnings recession and just start buying risk and start buying growth ahead of that, which is Bitcoin, big tech. And that's been, I guess that's been the playbook. And I think it's been exacerbated by quarter end dynamics and window dressing and this JP Morgan collar.
Mhm.
And so you have all these things kind of dancing together. But
Where do we go? Go ahead.
No, I was just saying, and just in concert, it's the selling of vol, right? I mean, VIX has these moments where it reacts to kind of things that people weren't expecting, and then once those things are over, the vol slam that happens is just incredible, and there's enough systematic capital that reacts solely to that VIX selling. And so as vol comes in, there's systematic releveraging, and the easiest way and the quickest way to do that is through S&P buying. And that's a hard thing to, as a bear to fight against.
But it's not just the suppressed volatility. I mean, we have rate volatility at all-time highs, right? It's extremely elevated and staying there, but we don't have currency volatility. So the FX market is still getting supported through US dollar swaps. So that suppresses volatility. We don't have equity volatility, really, that was a kind of one and done from 17 to 31 or whatever in VIX. During that pullback in late February into the banking crisis of all things, right? Then the bank bailout saved that whole VIX spike. But the point is, the only thing that is really kind of separately moving higher are credit spreads, whether it be individual issues like Deutsche Bank or Lincoln. I saw CDS spreads blowing out on Lincoln National. But I mean, there are select, what do you call it? The seek and destroy mode, right? Hunting for weakness in some of these financial institutions. But other than that, what are you seeing in credit? Because that's one area that the Fed doesn't have, let's just say, mechanisms like dollar spreads and the VIX suppression. So what are you seeing in the credit spread market?
Yeah, look, I think it's been, like you said, there's isolated cases, but it's of credit strain throughout parts of the cyclical components of the economy and throughout the banking sector. I mean, Lincoln, there's been talk about, these are life insurance companies that have these market-to-market issues, and they're not systematically important, and there's no bailouts coming there. So maybe they're at risk for, issues. I mean, if you have a whole life policy and you are struggling to pay your bills, you may take cash out, you cash out. So there's an element of that across insurance, obviously regional banks. I think Ally has a ton of auto exposure. And so there's pockets. I think it's not surprising that the pockets of weakness are where interest rates have had the most impact, right? Things that are maybe tied into housing, tied into autos, tied into financials. But as far as across the board wide swath of credit spreads widening, they're kind of trading in line with equities, right? So when equities are falling, credit spreads are widening, and then I look here, like this is the share, this is IG, then it kind of looks like the VIX chart, right? I mean, it's like this is moving up. This is IG spreads widening into the bank teeth of the banking crisis, and then boom, banking crisis solved. Credit spreads going back to they're up on they're wider on the year modestly, but not like materially so. I mean, but
they're staying elevated. I have kind of a similar.
And this is high, and I think you see a little bit more in high yield, right? This is high yield kind of made, very strong tights to start the year, and then widens out with the banking crisis, and this move down here, right? We've tightened, but not to the degree that, I mean, NASDAQ is here, right? NASDAQ is at the highs for the year. So that's where there is an interesting divergence there of high yield versus NASDAQ, right? I mean, you're just pulling up NASDAQ, right? You're basically at the highs of the year for NASDAQ, but high yield spreads are not at the tights of the year, right? IWM is not back to the highs of the year. So you're seeing some alpha, right? Which I think is commensurate with this view that, all right, here's IWM, not even close to back to the highs of the year. So I think on a day-to-day basis, it's crazy. It's manic, but if you were to step back and say, we're having the beginning of a credit tightening cycle, lending standards are getting tighter, banks are struggling more, there's capital flight across regional banks, there's markdowns in the commercial real estate sectors, and we're going to be going into a more of a hard landing scenario. What would you expect the end of March 31st to look like? I think this is kind of it, right? I mean, IWM's closest to the lows, maybe NASDAQ close to the highs, credit a bit wider. And so I think we're pricing in, we're pricing this in, but it's just, but it feels daily like it's maybe it's a little bit more manic than it should be.
Yeah, I definitely am tracking the high yield OAS. So basically this is the banking crisis, right through this trend line, and it has stayed there. Now, this is kind of a pre-COVID. I heard Larry McDonald talk about his 18, layman systemic risk indicators, and they're firing off, and he's expecting something between now and June. And I've been talking about that for over a month, right? So this is like the timing of April, Q2, something big. But the point is, this has already started to percolate. Not that it looks like a straight up COVID lockdown, which is a kind of freak of nature occurrence, but nonetheless, it has stayed elevated here, right? So this is all predates and leads up into the Friday freak, Silicon Valley Bank, lack of a better word, takeover, right? The whole bank run, and then on 12. So they've stayed elevated. They have not come back down. There's still risk premium in large part in this space, and it hasn't come back down. So that's a little bit different. Usually it spikes, it has these spiky little moves, and then it comes right back down. This one's staying elevated.
Yeah.
And then we have this, which is always, I love to get your feedback on this, which is, yield curve. Right now, we got a little bull flattening into potential, bull steepener, but we definitely have got this short end falling, and now the yield curve has retraced about 2/3 of its negative inversion just in the last 2-3 weeks. So when do we go positive real rates?
Yeah, well, look, I think what you're pointing to, and I'm kind of just thinking this out loud as we're discussing here, but again, just thinking about the entirety of the first quarter, there are certainly some signs that things are not looking great under the hood of markets, right? Credit is wider. And then on this chart here, it's hard to see here. You want maybe just let me share mine on the yield curve here just real quick, because I think
basically that it signals it's on the horizon.
Yeah. Look, I think it's the and this is just 2s, 10s, but just a kind of constant flattening all through last year, and then boom, banking crisis, and the curve is it's on this gap up, and the curve's kind of sticking the landing, right? I mean, it's staying. We're the most inverted that we've seen. We're not there anymore, right? If I look at 5s, 30s, similarly, right? Massive inversion, banking issues solved maybe, but not, right? We're not going back to the most inverted level here. I think when what the market is sniffing out this deterioration in growth that's coming from a credit contraction and an eventual slowdown in inflation, and a hard landing that will come. And so it's just a question of, when does that show up in the data? When does that show up in the psyche of equity investors to realize it doesn't behoove them to chase NASDAQ stocks at 50 times earnings? I think we're getting closer to that. And I think the cross asset pricing signals are suggesting a more dour outlook. You would expect to see this bull steepening at the beginning of when things start to really get concerning. And so, and I think, look, I think the fact that the Fed has not, clearly they've reacted, but they haven't gone full panic mode yet, right? The market is pricing in a Fed that's about to panic and completely. With
earnings aren't, but correct.
But I mean, but the Fed is not. I mean, look, this is. I mean, we've shown this before, but I mean, this is. The market is still pricing in kind of close to 50% chance of a hike in May, and call it 2 to 3. Call it 2 to 3 cuts by the end of the year, and I think we'll see. I just think if the Fed was super concerned, was more concerned, right? They wouldn't have taken. There wouldn't be a 5 point. There wouldn't be this dot up here at 5.9, right? Like this wouldn't. They wouldn't have taken up the median for 2024 up to 4.3, right? There'd be more indications of a Fed that was concerned, and they may be right, they may be wrong, but the market is saying they're wrong. They need to be cutting more, and the fact that they're being more resolute, I think, is this air pocket that is opening up to a Fed that is trying to, bring down growth and trying to bring down inflation in order to meet their mandate. So,
at what point do you think real Fed funds rate will go positive? We're right now negative 1.2%, and typically isn't that when the Fed does end up pausing, is when we hit that.
This is a chart I have for real 2-year yields.
They end the tightening cycle altogether, so it's not just pause.
Yeah. I mean, look, let's put this back 13 or so years. I mean, obviously we've had a significant tightening of financial conditions from a real rates perspective, from where we were at the depths of COVID. But I just think that with CPI doing this, right? CPI is still here. It's harder for the Fed to be so dovish. And so I don't know. We need to see more speed. We need to start seeing this really, really come down. And the indications from the early part of the year are that they're not yet.
I think they're going to start to pick up speed on the downside. So that's why I'm just asking, at what point, what level do we get to a positive?
Back to negative real yield, like a negative real 10s or something like that.
Positive. No, in other words, if we're negative.
Right now we're positive. You're saying when will they go back to negative?
No, the Fed funds rate, like the real Fed funds rate.
You're saying real Fed funds over on CPI?
Aren't we like -1?
Right now, the real Fed funds is 50 basis points, right? Of 5%, and the CPI that I just showed here is like 5.5%. So we're still kind of negative. I guess I gave a core one, didn't I? Let's see what I do. Okay, so you're right. So 6% CPI, we're 5% inflation on rates. So you're -1%.
1. Okay.
You're -1 on real. I think the 5% Fed funds rate stays. By June by June, this is going to be significant. This will be positive for sure.
Yes, that's right. That's where I'm going.
Yes. Sorry, I was misinterpreting. Yes,
that's exactly where I'm going.
Actually, I'm pretty sure by May, which we'll get that data early June.
Yeah,
we will show positive real Fed funds rate based on that metric.
But they're going to start pulling that forward, is my bet. So let's just say April 12th. I'm going to swag it and say 5%, which it's not likely because we're 6. But the point is, we're coming down, right? I think we're going to come down faster. So they're going to start to price that in, is my bet. So I think we're going to come to the end of this tightening cycle sooner rather than later, honestly. So that's why, equities are doing what they're doing. But it's funny how they're pricing in the no landing, the cuts, but no landing and no recession in earnings. Something's got to give. We have a few questions and I don't want to miss it. Okay, the first one, I'm not quite sure. My Fed is trapped comment or mantra that I give all the time is basically that when they do pivot, right, which I think is going to be May, right, we're going to get that clear tell sign. that the hiking regime is over, but that's exactly when inflation expectations will start to creep back up. So it's going to be not the end, but like, 70s, we had multiple peaks of inflation and also equity bottoms. So that's what I mean by the Fed is trapped. Adam's saying pull up a 6 or 12 month chart on SMH over the last year. That's been mentioned as one of the most meat on the bones to short. I've said that and been wrong, but it just goes higher. No one has a crystal ball, but looking back, what do you think you missed on this sector? Are there areas now where you might consider the direction based on this read? Okay, not being credible, just wonder where your thoughts are on this. I did a big thing on Tuesday on this, Adam, which was, and I posted this for clients as well. Hold on one second, let me get this for you, because I love this chart, and I think this is absolutely the roadmap. And I've been saying it's not ready, but here it is. All right, so hold on 1 second. Share screen right here. All right, so we have not, because they've been acting as cyclicals, and this whole space of, tech getting bid up on looser monetary policy has definitely benefited semis and the whole cyclical rotation. I think it kind of double wind at their back. But this is a monthly chart. This is my intermarket of basically this SMH to SPY. So big picture. This is way over here is a 2000 high, right before that bubble burst. And I am only intonating the potential for this head and shoulders in semis. I'm looking for the rollover. So where I thought we were going to get dinged was when we got up to this kind of neckline here. I thought we were going to hit it and then come back down. We did not. We went clear through it. This has been a clear melt up since October, like literally since October. And semis and tech, the market in general, got extremely supported in mid-October. And I can show you this a lot clearer in the next chart. And this is right here. All right, so this is the same idea. This is NASDAQ to SPX, but on a monthly. Here's your 2000, bubble burst, where the NASDAQ, by the way, went up 100% in 1 year. So it was a massive parabola, and parabolas are trapped longs. They equal, they trigger volatility and then liquidity events. Over here, if you remember, I was a big, NASDAQ underperformance bear at the beginning of, at the end of 2021, at the beginning of 2022. So that was my number one call. NASDAQ outperformance of 13 years would end, and it was based on this head and shoulders. We came all the way down here, had a little bounce. August, we rolled over, and this is October. October, we had $1 trillion in liquidity. It just helped support the market, is all there is to say about that. The Fed, the Treasury, the Bank of Japan, PBOC, Swiss National Bank, dollar swaps, left, right, center. So there was a tremendous amount of support that came in. And remember that call on literally October 20th, and I said, brace for impact if bond bulls don't defend here, and we got supported. So October 21st, Bank of Japan came in, and that was it. The dollar yen just started falling from 151. It's now 131, and the market just went straight up, not straight up, but this stick went straight up. This ratio went straight up, and we have been very firmly supported. So now what I'm looking for, and I don't see it yet, is that inflection point where we trigger the underside of this trend line in tech. And the same thing with the one that I just showed you in semis, right? Also on a monthly, where we see an actual peak and then a rollover, peak and then a rollover. And then this is obviously has not peaked yet, but I'm waiting for that rollover. Long story short, that's the telltale sign I have of when we're going to have a trend reversal, or earnings will start to price in this recession risk. Because right now you can't have your cake and eat it too, where they're pricing in cuts. So they're rising on loose monetary policy, but they're not revising estimates to reflect the recession hit. So that's the point where I'm looking for a more confirmed short in both tech and semis. Hopefully that answers your question. Okay. You want to answer the next one, which is Mike is saying, what's a JP Morgan caller? What is it, and what's the impact on the market?
Yeah, not a total expert, but what I do know is that JP Morgan has this massive kind of S&P fund that is a hedged product. So they are trying to dilute the just the wings of volatility, both on the upside and downside, and kind of improve the, the sharp of that product. And it's a very big fund, a lot of AUM. And so every quarter they have they put a structure in place basically to protect against kind of big drawdowns. They basically, they buy a call and they sell a put spread. They buy a put spread and they sell a call, buy a put spread. The put spread is now completely, is much lower and out of the money. That was last quarter's, right? I think, because we're at the level that we need is the
yeah, this one was the roll on 12/31, because I wrote this on January 11th. So
I think 4065 is the number though.
Okay. All righty. I'm in the ballpark with the
yeah. So
all right, 3,600 by about 3040.
And it's a cash price for, and they do it. It's a cash price for the end of this quarter, 3/31. And so what's been happening is every day we're getting closer. We're kind of grinding up into that point. But to the extent that we don't get there, then that structure that part of the structure will end, will be worthless. And so there'll be some stock for sale, and then they'll roll again in a sizable way. This will all happen on Friday. So I think what's been happening is in without a lot of volume over yesterday and today, the market's kind of just been drifting up towards that strike. It's been like a magnetic pull because there's a big amount of gamma that exists there. But with a day and a half to go, because they like to roll that structure at points during the day on Friday, I think we're kind of we're almost to the end of this saga. But I suspect what will happen is that the market won't get to 4065. There'll be a decent amount of stock for sale into the bell on Friday, which will just pressure the market a little bit. I think that, but I think what the impact has been that we just have been grinding up towards that, and then they'll reset the strikes. We'll find out what that is on Friday, and there'll be a new set of numbers for for the next quarter. So it's just another flow that exists out there. But
it's mammoth. So
and like I said, without any fundamental data, it could have you have, and as we get closer to the levels, we have dealers that have to adjust exposure, and because of the size of it can move markets pretty aggressively in a very short period of time. But Friday we also get the PCE, so that's the February inflation print. So there is a fundamental data point that is coming out on Friday, which could be market moving. So maybe that just trumps that that strike, but it is something to watch. But I think at this point the impact's been largely felt. There could be some selling if we don't get there Friday afternoon, and then as it gets restruck on Friday, next week we'll go back to trading whatever we were trading.
Okay, and this, I was asked about the financials. So here's a chart that actually you and I put up 1 month ago, right before, I think it was on the Wednesday the 8th, before the 10th, 11th, 12th was the bailout. So this let's do this, share. All right, so literally on the 8th we were talking about this. It was actually no, that was for our Edge clients. Yeah, that was for our Edge clients. Okay, so never mind. But this was a chart that I had shown on March 8th, which was basically swing short reflation trades, specifically banks on higher terminal rates. Had nothing to do with the bank crisis looming. I had no idea. And so this came down and obviously tagged 3250. Let me see what was that last one. Yeah, we blew through 3250, but when you're asking in your question about financials, I just saw the question. Where the heck did it go? There it is. Okay. When would you be short financials at this point, even the credit tightening, or is that trade likely over? Okay, so this was already reflation trade short, and that's deflation impulse. That, in other words, CPI to me is going to continue to roll over, right? So that a lot of these reflation trades were at risk. Anyway, the point is it did tag that 3250. It has actually come all the way down to the 200, which was 30.75, and it has been bouncing. But I don't see any reason for that not to continue lower, especially since that space is going to be, as Craig said, it's kind of like uninvestable right now. Might be a reflexive bounce or two. There might be, for sure, some value. For sure, there was some stuff that was sold off indiscriminately, right? Sell first, ask questions later. But I still see a lot of risk to the downside in the financial space, especially if they're tightening over the next year, and that starts to really hammer the economy. But for right now, there's a gap fill, which is the November 2020 gap fill that has not been hit yet. Wait a minute, am I in the right one? No, that's no, yeah, that is November. So this is basically the COVID, the Pfizer vaccine gap up, and I believe the blue wave gap up. Let me just check that real quick to make sure. Oh yeah, definitely. We have so much more room. Yeah. So this is basically right here. This was where Pfizer came out and said they had a vaccine. And so that created a massive market move. So XLF big picture, depending on your time frame, of course, this is support, just like it has been here before. But next time this is taken out definitively, we've got some lower levels, but this is more for the rest of the year. Definitely not a Q2 thing. All right, so you want to answer the next question? How long before the twos, the short-term rates, money markets start to really drop? I think they have.
Yeah, let's share that. Second. Where is this? Sorry, share screen. So, look, I think, like I was mentioning earlier, there's been a story of various narratives this year, right? This is to start the year, concerns about recession, 2-year drops, 445 down to 410, big employment number, bounce massively, grinding higher, inflation comes in better than expected, keep grinding higher. Okay, maybe January data is a one-off. New inflation data, employment data comes in, confirms January wasn't a one-off, and boom, we're up. 2 years are going vertical. They get above 5%. Terminal rate bounces out to, I think the high was 560 or something along those lines, and then banking crisis, and it's gone. Right. So we've taken out massive chunk of this, and now we're back down to the 4.1 camp. We got as low as 375. I mean, look, the question that I have is, it all really comes down to the resoluteness, if that's a word, I think maybe it is, of the Fed to stick with their idea that there will be no rate cuts in 2023. And so you're really at this point, I think, making a call on whether or not we are going to have a banking crisis or not. And look, I think in light of what I think, if I'm thinking out loud here, in light of what the Fed has done to provide these facilities and the discount window to a variety of banks, to all banks, really, my sense is that the short-term strain of a banking crisis where there's a run on a particular bank, I don't suspect that is going to happen further from here right now. But what I do see happening is I do continue to see kind of a slow motion, train wreck, really, for banking deposits. I mean, why would you keep money in some of these smaller and regional banks and savings accounts or checking accounts and earn zero? So I think we're going to continue to get flows out of the banking system and flight to money market funds, which invest in largely short-term treasury paper. And so I think it is likely that we are going to have a credit contraction. I think it's likely that we're going to have more of a hard landing, but I think that's going to play out over more of a period of time, rather than that's something that is an imminent, bank run on every bank. So as far as the 2-year is concerned, I think it's more likely to be range bound here for, a little bit. If the data comes in good end of this week and early next week, that March was fine. And really the economy didn't really miss much of a beat from this this banking issue, then I think you're going to see these 2-year yields grind higher, terminal rate grind higher, take the odds up of the May hike from 50% to 80%. And we will deliver that hike, and the market will start to price out some of those cuts. I think that is that's the more likely path for call it the next 2 to 6 weeks.
All right. And I just think that that's a trend reversal. In other words, that the very short end has stopped going up. It was just such a massive reversal that I think it's done for a few quarters. I think we're gonna go from that bull flattening into bull steepening, but it leaves a huge gap behind. So right now, that's just in my technical analysis book, a trend reversal.
How quickly do you think that plays out based on what you're?
What do you mean? When the 10-year gets right back down. What did I have that on a monthly? Hold on. When you say timing is tough, but we did the bearish engulfing that triggered. So I've got 2.8%, 2.6%.
For a 10-year or
for the 10-year as an out, like we've been going really just if we're going to start weakening this deflation impulse, it's going to pick up the next few months. I can see a low of, believe it or not, 2.8% in the 10-year, maybe an overshoot to 2.6. I don't think it goes below that, but that's definitely where I can see a pullback in the 10-year. So anyway, I'm just saying that for right now, the shortest, the 3, the 6, the 1, the 2, they absolutely had this massive volatility over the weekend, and that particular drama is a trend reversal right now. Technically speaking, doesn't mean that in time later it can't go back up. But for right now, it's solidly broken. In other words, that uptrend was solid.
Yeah. And look, I don't expect 2 years to go back to. I think we've made a high in 2-year yields. But I don't think you're going to see a significant move lower in yields unless we see a significant move lower in stocks, right? So something that really so that's why I prefer being short stocks than being, trying to catch a bond move lower, a long move in bonds with yields going lower.
What's your view on gold?
So, I've been constructive on gold all quarter. Caught a nice kind of long gold, short IWM trade. That's really worked out. Look, I think gold does a great job anticipating Fed liquidity. And so somehow, gold figured out that a banking crisis was coming and the Fed was going to be adding liquidity, and not surprisingly, gold ripped and kind of got to 2000 and, now is digesting here. So like if the banking crisis accelerates, gold will keep working. If the banking crisis kind of just tapers off a little bit here, maybe gold has a check back a little bit here, but on a 6-month basis, I'm very constructive on gold still, because I do see more of a hard landing. I do see ultimately rates likely having to move lower, a Fed that will be forced into accommodating, and geopolitically, look, there is a growing concert of countries that are beginning to transact away from dollars and use RMB or gold as a neutral reserve settlement asset. And I think that is a trend that is likely to accelerate over the course of the next several quarters. You have just the Russian expropriation stuff. You have the way that the US is dealing with the banks here and the money printing again. So I think this is a trend that is going to likely accelerate. You have meetings in May, the Shanghai, China, or the SCO meetings are kind of China, Russia, the various stands. India, Pakistan. They just invited Saudi Arabia into that mix.
that.
You also have the BRICS conferences that are looking to add Saudi, Iran, and various others. There is a growing Eastern bloc that will continue to trade away from US dollars. And I think on the margin, that is good for gold from a geopolitical point of view. So, and then the last, this is a little bit more conspiratorial, but there's always this talk of in the debt ceiling issues, the platinum coin, which I think is ridiculous. But the US does have a significant amount of gold holdings on Treasury and at the Fed. So the US does own a lot of gold. There could be a case to be made for why you would revalue gold on the US debt, on the US government's balance sheet, as a possible way to get around some of the debt ceiling issues if this becomes a saga that they can't deal with. So that's more of a kind of out of left field potential type thing, but it's possible. So I think there's a lot of underlying momentum for gold, and I don't think anybody really owns gold. There's not been a ton of flow. It's not really part of folks's portfolios, broadly speaking. So I think there's a lot of room for capital to flow into the space as you're looking for a home and looking for a store of value. But
it is also kind of inverse for sure, not just with dollar, that everyone kind of assumes. It doesn't always work that way, but you can see the buying after the buying of gold as dollar is coming down. They need less of them. These dollar swaps are in the system versus the opposite. When yields were spiking, emerging markets were panicking. You could see, this thirst for dollars, right? And they were selling gold hand over fist. It's also a collateral, so it can get sold even in times of extreme panic like COVID. It still crashed before it went higher, and then it rolled over. So it still is a means of exchange, clearly, as it relates to where the dollar is positioned relatively. So, but yes, I have it very trend strangely, which was very strange. It's choppy as could be, but it was trend bullish earlier in the year, and I didn't really believe it.
Yeah,
because it's been so long.
Right. I think folks have it like this is a chart of gold versus real 5-year yields, and I think inverted, right? So typically you see gold, which is the white line, going up when real yields are negative, right? As real yields get more negative, gold typically outperforms. And then when real yields move positive, gold underperforms. There has been a massive opening up here of how strong gold's performance has been while real yields have gotten incredibly positive. And so, look, some folks would say that's a mean reversion ready to happen. And the question that I think is worth proposing is whether or not this time is different, which is obviously, a nerve-wracking thing to say out loud. But when you think about what the U.S. Has been doing with respect to Russia and sanctions and possibly sanctioning China, when you think about the debt ceiling, when you think about the Fed's reaction to this banking issue, it wouldn't, it's like gold is possibly signaling something new, some sort of new multilateral currency regime being developed or something. Otherwise, gold would not have done this, right? It way outperformed expectations last year while real rates were ripping. And so to the extent now that real rates are likely to fall again because we get more deflation or have you, gold can make that next move higher. And so to believe this gap, you need to believe that this time is different. And I think there are fundamental differences that are going on as the dollar starts to lose, some of its luster, lose its place in global trade transactions. So I still like gold.
Okay. And the last question, because Tracy, I don't have an opinion on the BDC that you're asking about, but I have a fabulous client, Tim, who's every morning in my live trading room, who specializes in REITs and BDCs. Like, this is his wheelhouse, and he's very happy to give his fundamental assessment, but I got nothing. So Ares Equity, I don't know. It's a levered non-bank private lender. Wish I had more, but I really don't. Anyway, the oil view, because I think we need to kind of wrap this up. It's already gone over the infamous power hour. This was a baseline. Let me just bring this up and kind of get this volatility chart up. You're asking about my negative. You don't mean negative oil, but I mean I was negative oil. Okay, so when we last did this review again around the 8th, it was okay, shorting reflation trades, whether it be banks and oil, etc. Price target was a 65.65 with an overshoot to 62. It was also helped by the fact that oil volatility, let me just find that oil volatility chart. Is this it? There it is. This was on the 10th, but it was the same idea that oil volatility was about ready to move, right? I track volatility of the underlying as best I can, and it certainly did. This is also XLE was going to roll over. So that was kind of the basket case, the basket trade, I should say, of shorting oil. But it did hit that 65.65, and obviously it's gotten strongly defended, almost tagged 75, but I think it's going to roll back over. So this was the chart at the time that Robert had posted for clients, which was basically that the spread traders and those in open interest were surprisingly in the market again after being very, very absent. And there was risk that the unwind would be actually the short, and it ended up being exactly that. So we dumped. In fact, hedge funds sold oil in 2 weeks. More oil. They sold more oil in 2 weeks than they had in all of last year. It was a stunning kind of speculators unwind. So anyway, so having said that, long story short, we did hit this 65.65. We poked a little bit below it, 64.50, and then we got right back up into 75. So this is where I'm looking for the next. If we're going to fail, we're going to see it come down into potentially the 50s area. But this is what it looks like right now, right? So kind of came down, tagged that 65, and so far we've gotten stopped in the 74, 75 area. Maybe we jump the shark and we move higher, but as Robert likes to remind, we're in an intervention collar. So we're not going to go too high or too low because the government's going to make sure of it. So long story short, I think we absolutely in a deflation impulse can push lower again into this kind of, you can kind of see it right here. But right now it's getting defended. And nat gas, I have absolutely no opinion on nat gas, none. I don't like it. It's not easy. So I think we went through pretty much everything. Yeah, we got anything we didn't cover? And I just feel bad about not answering Tracy's, but I got nothing on BDCs. Sorry about that. All right, so you raised your hand, Craig. What do you want to say?
No, I didn't. I was looking to see if there's any more questions.
All right. So long story short, we're going to do this again in a few weeks, but for clients next week. And then I think I'm going to have Jeffrey back, who I had while Craig was on vacation in California with his family on break, to talk about Bank of Japan and commodities. He's the Treasury buff, so he's really into the whole Treasury market and also dollar reserve currencies. So he's going to come back and finish up his presentation on Treasuries and Bank of Japan and impact on commodities moving forward. He's also a big silver buff. Anyway, that'll kind of complete the education that I wanted to present for Jeffrey later on in April. But for right now, I think we're done. Any last questions or comments for what we're looking ahead for macro event driven risk for the next few weeks, Craig?
Yeah, look, we're gonna be having inflation data later this week, and then next week we'll get the first round of data for the month of March. We'll get some ISM data. We'll get the employment data next Friday, which is Good Friday. The market's closed, but the data comes out. So it's kind of a confusing day. Futures are open, but the market is closed. And then as far as central bank is concerned, I mean, there are still speakers every, every day, really. I mean, tomorrow we get 3, Barkin, Collins, Kashkari. On Friday, Williams, Cook, and Waller. Next week, Mester and Bullard and Goolsby. So look, we're going to continue to hear from the Fed and how they are thinking about this banking crisis versus this inflation fight. And we'll get more data. So I think
earnings starts.
And then earnings start. So you'll get, for the next 10 or so days, you get kind of macro, then you kind of move into a 3-week micro period of earnings will be the driver. And then, end of May, it'll be back to the macro saga again. But as far as, on weekly perspective, every Thursday is when we get the Fed's balance sheet as of end of day Wednesday. So tomorrow afternoon at 4:30, we'll get a look at the Fed's balance sheet as of the end of the day today.
Okay.
And then on Fridays, we get the bank's total deposits with basically a 2-week lag. So one of the things, just last chart, I know we're running out of time, but I think this is an important chart here. This is something that I think we need to keep watching is small bank deposits, right? And so this is as of March 15th. So we're now, this is 2 weeks, basically have a 2-week delay. We'll get the next data point on Friday. And this is the drop we saw last week from 55, this is the 100 billion or so drop. This is the biggest drop we've ever seen. Of small bank deposits. But if you look back, the Fed has pumped a ton of money into the system that we're just starting to see, the flight here. But we get this data on Fridays. So we'll watch what's happening with the trends at small banks. We get the RRP data. This comes out, this is every day. So we get this. RRP's been growing again. We get this data point every day. We get the Treasury account information every day. Right now, the Treasury general account is down to like 160 billion. We've drawn down a ton.
That's a ton
of that facility. So look, the market's going to start trading. We'll start trying to, suss out whether or not there's a banking run, whether or not there's going to be a credit contagion, whether or not there's still inflation. And so we'll have to just kind of keep an eye and see. I suspect I know where things are going to be later this year, but as far as the timing to get there, it's still hard to drill down. But if the data, I think my base case is the data for March probably comes in better than expected, because I don't think that the credit issues that I've seen so far were enough to kind of stop consumer momentum. But as we start to transition into more of the second quarter, there's been talk already about some of the credit card data starting to weaken, the tax refund data starting to weaken. We know that there's a debt ceiling issue that's going to become front and center. So I think we're going to be in for a tough period, second half of this quarter and next second half of the year. But April is kind of maybe it's a little bit of a crapshoot because it's a new quarter, new money, maybe some rotations. Tough to navigate, but my sense is earnings are underwhelm, outlooks underwhelm, and then the macro data starts to deteriorate, and then we're starting to ask the questions of whether or not the likelihood of a 200 per share earnings print is more likely than not, and what kind of multiple do we put on that? And that's how we're going to open up the window for significantly lower equity valuations and equity prices.
And just because I grabbed the kind of key charts that I want to end with. This is the chart that Craig is kind of referring to as it relates to small bank deposits.
Yeah, that's right.
And they've already been petering out through 2021, but now they're really picking up speed to the downside. And obviously, large banks are the receivers or money market funds, T-bills, cash. There's definitely been a migration to safety. This is earnings coming up. My bet that this year we're going to retrace this breakout. And obviously very slowly right now as of Q4, but we'll see if that picks up speed later on, because recession risk is still getting pulled forward. So as we have already gone into kind of that bull flattening with potential to do bull steepening, that definitely makes the risk of recession, more imminent. Gundlach was out the past few days, pulling that forward, and a whole bunch of others. In the short term, however, I've got two charts that I'm watching very, very closely. One is this growth to value rotation. We obviously had value to growth since the January effect, sideways petered out. The reflation trades then rolled over with banks, and the mega cap tech concentration picked up on loose monetary policy. But there is still stress in the system that has not abated. So this is a pattern breakout that has stayed elevated in high yield spreads. So I watch that also every single day. And obviously, if it comes down, it's market bullish. And if it moves higher, it's market bearish. And with that, thank you so much for joining us on this public version of Macro to Micro Power Hour. Craig Shapiro, MacroAdvisor EDGE Manager, and myself, Samantha LaDuc, founder of LaDucTrading.com, are very grateful you attended. Thank you so much. Have a great
Thank you. Take care.
evening. Bye.
Bye-bye.